The number of companies going bankrupt on a weekly basis has been rising significantly over recent weeks, according to Apollo Research. Now, this is happening as bond yields reach 4% for the first time since Silicon Valley Bank blew up and ultimately led to the regional banking crisis. And before that, the UK pension fund blow up that also caused bond yields to turn back down after hitting that 4% level. Despite financial stress like increasing bankruptcies, a potential banking crisis, a pension fund blow up, the Fed continues to adopt a higher for longer tone where they expect to continue raising rates or keep rates at elevated levels in an effort to cool inflation down, with US core CPI, core inflation, that remains above 5% right now, above the federal funds rate. And despite all this stress on the market and interest rates continuing to rise, the stock market continues to go on a melt-up. Now, in today's video, we'll be looking at the rising level of bankruptcies that we're seeing in the US, try to understand if this chart is actually giving us an accurate picture. Is it going to get worse from here as the Fed keeps rates at elevated levels? And why is the stock market not reacting to this financial distress that we're seeing on the market? And I'm also going to show you why speculative grade debt is going to hit a big maturity wall in 2024 that actually puts a ticking time bomb of bankruptcies unless the Fed changes course. Welcome back to Game of Trades. I hope you guys are going to enjoy this video. If you do, make sure to click on the like button down below. It helps the channel out a lot. And of course, subscribe to the channel if you haven't already. Now, without further ado, let's get right into it. Now, a recent survey from Deutsche Bank actually shows that market professionals aren't too worried about higher interest rates. Most agree that higher rates are going to cause some market stress, a little bit like the market stress that we've seen so far. 20% of market professionals actually think that any impact on the market is going to be very limited, and less than 20% of market professionals think that there are big risks of serious financial stress as a result of higher interest rates. Now, one of the impacts that we've seen underneath the surface as a result of higher rates is that businesses are having more difficulty to borrow money, especially over the last few months. Now, as interest rates go up, credit tends to tighten, and companies have more difficulty to borrow money to expand business operations or simply to refinance debt. And what we've typically seen leading up to recessions, you can see here the gray bars mark the last 3 recessions that we've had since 1986. Leading up to recessions, we typically see that businesses have a harder time to get credit. We saw that in 2007, we saw that in 1999 right here, and we saw that in 1989 as well. In all 3 of those cases, that dynamic happened after a tightening cycle from the Federal Reserve in 2007, 1999, and 1989 as well. So the data that we're seeing here on this NFIB survey does align quite well with the bankruptcy filing increase that we see on this chart from Apollo Research. Now, what you have to know about this chart is it actually only shows bankruptcy filings for companies that have more than $50 million in liabilities. So that's quite a specific sample and perhaps doesn't show you the complete picture. Now, this is a chart I wanted to include in this video because it went around quite a bit on Twitter over the past couple of weeks and paints quite an alarming situation, but that also doesn't fit with the rising stock market that we've seen over the past few months. If we look at total US bankruptcies from this data set showing the US new bankruptcy court filings, it paints quite a different picture where bankruptcy filings remain quite low on a relative basis. This is a chart going back to 1995, but they do seem to be turning up here over the last few months. Now, you can see in 2000 and in 2007, in the last 2 recessions, you did see quite a big surge in the number of bankruptcies, and that aligns a lot more with the price action that we had throughout the 2000 and 2008 bear markets. We haven't seen that type of panic yet in 2023. But now I'm going to show you why this is very likely only the tip of the iceberg when it comes to defaults, and why the longer the Fed keeps rates at elevated levels, the worse the bankruptcy numbers are going to get. In 2023, we don't actually have that much debt that comes to maturity. So most businesses that are in financial difficulty actually don't need to worry about refinancing their debt this year. That actually comes in 2024. Now, this chart shows you how much debt comes to maturity every year and shows you the proportion of speculative grade debt against investment grade debt that comes to maturity. Investment grade debt is what is deemed to be relatively safe by rating agencies. Now, of course, as we saw in 2008, we should take these ratings with a grain of salt, but speculative grade debt is actually very likely at a higher risk of default. In 2023, only 17%, around $700 billion of debt comes to maturity. So all the businesses that refinanced in 2020 or 2021, when interest rates were at zero, they don't need to worry about refinancing in a higher interest rate environment just yet. Most of that will come in 2024, where around $1 trillion worth of debt is going to come to maturity, with around 30% of that debt being speculative grade. And in 2025, that number goes up to 1.2 trillion, with 40% of the total debt being speculative grade. So what this chart really shows you is that we haven't really seen the impact of the rising interest rates that we saw in 2022. That's the primary reason why the market doesn't seem too concerned right now. And it's also the reason why credit spreads are still very low right now. Credit spreads are a great indication of how much credit risk is currently priced into financial markets at any given moment. You can see they typically rise into recessions. This is 2001. Credit spreads widened considerably throughout the recession as default rates skyrocketed during that recession. In 2008, of course, you saw credit spreads widen considerably as well, peaking at the height of the financial crisis. And more recently, despite some bankruptcies that we're seeing, more difficulty for businesses to get access to credit, well, we haven't really seen a skyrocket in credit spreads. Recently, they rose a little bit in the first half of 2022 here, but since then, they've come back down and are still quite low. And one of the big reasons is that, first of all, companies haven't had to refinance their debt yet. And the second reason is that we haven't really entered a recession yet. And you can argue that between 1998 and 2002, you had a similar type of behavior where the Federal Reserve actually kept interest rates quite high for an extended period of time. And you gradually had the market price in more and more credit risk all the way up to the recession, where credit spreads ultimately spiked and peaked. So with the Fed keeping rates at restrictive levels, it's likely we can expect the market to price in more and more risk, causing credit spreads to widen and potentially causing pain in the stock market, with the peak of the panic most likely occurring during the recession, at which point the Fed is going to be forced to ease monetary policy and stimulate the economy. Now, rising credit spreads is actually one of the big investment ideas that we've done work on at gameoftrades.net. We're still looking for the right timing for this trade. We'll of course be sending a notification when we deem that it is ideal. But we do think betting on rising credit spreads in this type of higher for longer macro environment heading into a recession can potentially be a very interesting bet. If you want to stay up to date on how we're executing that trade, make sure to subscribe to our service, gameoftrades.net. Now, I hope you guys enjoyed this video. If you did, don't forget to click on the like button down below, and of course, subscribe to the channel if you have not already. Now, in the meantime, I wish you good luck on your trading, and see you next time.